18.6-year property cycle is a theory suggesting that real estate markets experience a cyclical, predictive pattern of booms and busts every 18.6 years, 17 to 21 years on average. The cycle typically includes period of rapid price growth, a subsequent crash, and then a recovery. And advocates of this cycle suggest that in 2025, 2026, we will experience the mother of all price crashes since the global financial crisis in 2007. And in this episode, I'm going to take you through some data so we can discuss whether this theory is accurate, A, whether it's accurate in the Australian context, B, and also, even if it was accurate in the past, whether anything has structurally changed so that it is no longer accurate in the present or in the future. This is really important because if you can predict this stuff, then you can hold off buying until the perfect time, at which point your house prices will grow massively, you'll make a lot of money. Or if you get this wrong or think about this incorrectly, you may wait until buying, and in that time, prices may have gone up 50% or doubled, and you'll have massive regrets. Let's get into it.
Welcome to the Oz Property Investment Mastery Podcast. My name's PK and I help busy people build passive income by buying top 5% growth and cash flow property and build a portfolio using data without wasting months doing research, spending weekends at inspection or catching flights, or dropping $10,000 to $20,000 on buyer's agents every single time. So if you're confused, lack confidence, and just overwhelmed with all the information and marketing misinformation available online and don't know where to start, then this show is for you.
So here's the theory for those of you who don't know. Typically there's a big recession or market crash, just like in the GFC, maybe because of some undue or imprudent lending, or there could be an oil crisis, there could be a foreign exchange crisis, there could be a war. There's different reasons for crashes. And after crashes, the central banks and governments typically pump the economy with money by either lowering interest rates or fiscal stimulatory policy by the federal and state governments. And so therefore you have this recovery phase. And as this recovery phase gains steam, people start to make money. But of course, you can only realize money, whether it's in the stock market or in the property market, by selling your asset. Now, of course, in Australia, you don't have to sell your property to get more real estate because you can take equity out. But let's just park that to the side for a second. They take their profits, and so therefore more supply comes onto the market, and there's a little bit of a mid-cycle dip. This period lasts for about 7 years as per this cycle's theory. And then people realize that nothing has changed from the previous heydays, and there's no point taking out your profits when you could have been in the market to make more. And at this point, people would realize that actually this market is not structurally going down. It's not a bear market. And a lot of people who didn't make money in the last 7 years think, okay, there's been a small correction, a dip. Maybe I can buy the dip, quote unquote, and make a whole lot of money. There's a lot of FOMO, and the people who previously sold also jump back in because they see this positive trend, this positive momentum. And then that subsequent 7 year cycle, as this theory suggests, 7 to 14 years at this point, is even more explosive than the recovery phase. And then people get too happy. They start paying ridiculous amounts for either real estate or stocks. Lending becomes irresponsible. There's a sense of gluttony or people overexerting themselves, creating lifestyles and investment philosophies that aren't rooted in structural long-term fundamentals. And so therefore, that house of cards, quote unquote, collapses. And then you have a recession phase from years 14 to 18, about a 4 year cycle at that point, after which the governments and the central banks come back in, stimulate the economy, and there's the economic cycle, and the recovery phase starts again. So Phil Anderson, who has advocated for this 18.6 year cycle, which really means on average between 17 and 21 years every time, He suggests that it's fairly prescriptive and investors should time their market entry and exit according to this cycle. And if that was true, that would be awesome because I could just tell you right now where we are on that cycle. And I could say, guys, right now, we're right at the top of the explosive phase. Sell all your assets or don't buy anymore. Or I could say we're in the mid cycle dip. Seems a bit iffy, but there's a huge boom on its way. It's not as easy as that, as much as I wish it was. And so to prove this point, let's consider some years and understand where they could have been on the cycle. And let's say after the global financial crisis, which happened in 2007 to 8, 2011 was really the start of the recovery phase. And so the theory would go for the next 7-ish years, there's a recovery. But actually, in Australia from 2012 to about 2015, it wasn't just a recovery, it was a positive explosion, especially Sydney and Melbourne property markets, which are really dictating the national average weighted index price growth. They took property prices doubled. And so that's not just a recovery, that's an explosion. And explosions aren't meant to happen right after a recession, according to this theory. Then, following that, in 2017-18, there was a bit of a mid cycle pause and house prices went down. Sometimes they say that was in 2020, but really it was in 2017 and 18 when Sydney, Melbourne went back about 8%. But that should have been a huge crash, not just a mid cycle slowdown, because the previous 5 years were an explosion, not just a recovery. And then from 2019, we started seeing property prices start to rise again. Of course, 2020 with COVID was a bit of a blip in the market. And then in 2021, we had a huge boom. So it's almost like we had another explosion. And in 2022, prices came down again ever so slightly. So we didn't have this extended period of time at which there was either a recovery phase or another 7 years of boom. People think there was a huge COVID boom that lasted over the last 5 years, but according to Core Logic, since COVID 2020, we've only seen a 39% rise in Australian house prices, which of course is much lower than the previous decade. People normally say house prices in Australia double every 7 to 10 years in Australia, which of course is true over a 90-year time horizon. But in the last 5 years, they've only risen 39%. So at this rate, we're nowhere near doubling house prices in this decade from 2020 to 2030. So there wasn't a huge COVID boom at all, which kind of goes against this theory. And so where are we right now? We're not coming out of a huge boom explosion period, nor are we coming out of a recovery period because it's been choppy. Is 2021 was big, 2022 was low, 2023 was flat, 2024 was good for some areas in Australia, Perth, Adelaide, Brisbane, but not for places like Sydney and Melbourne. So you can see how this theory, for all practical purposes, starts to lose its appeal. And then you might say, look, that's in the Australian context, PK. What about US, which is really where this theory was born? But according to the Schiller Index, US house prices all the way from 1950 to 2024 have only really fallen in about 7 years. In 1990, where they fell 0.7%, in 1991, where they fell 0.2%, and then from 2007 to 2011, where they fell from between negative 11.9% to negative 0.38%, depending on which year you're looking at. There was 5 years of negative house price growth in the US from 2007 to 2011. Apart from that, it's all green. Every cell from 1950 to now, apart from those two periods that I've mentioned, are in the green. They've always had positive price growth. So what does that mean then for the supposed 18.6-year cycle? I don't see any pattern of 18.6 years according to even US house prices. And I know a lot of people want to believe that there's a big crash coming in 2025 or 2026 or maybe even 2027. According to their estimate that we are roughly speaking 17 to 21 years past the last massive crash, quote unquote, in the GFC during the global financial crisis in 2007 and 2008, which, by the way, only led to Australian house prices going down by a maximum of 8%. And even during which time there were places like Bendigo that continued to rise. Putting aside that small detail, what's very interesting is that for there to be a huge crash, there would have had to been a big boom leading up to it. Now, I already illustrated that Australian house prices only grew by 39% in the last 5 years, but what about the actual economy? And when you look at that, you see that from 2020 to about 2028, the real and forecasted growth in the global GDP is actually lower than the previous decade from 2010 to 2020. In 2010 to 2020, GDP grew at 3.2%. In this decade, it's likely to only grow at 2.7%. This goes against this theory as well, because this theory is presupposed on economic prosperity that drives asset prices, and then there becomes complacency and gluttony, and that is when house prices and stock market crashes. But we haven't seen a strong local, global, or American economy since COVID on a GDP basis. Of course, inflation has been out of control for a while, but on a pure GDP basis, which is the best indicator of global growth, it's not been there. So this theory's fundamental basics and cogs haven't been supported this time round. And then, of course, you have to understand that a cycle is not going to materialize just because the theory ought to transpire. It actually will come to pass based on real world economics. And the reality is right now that in Australia, we have a housing market chronic shortage. Around about at the moment, by more than 100,000 dwellings. This is according to ABS and Oxford Economics. In fact, this data is a bit old. Right now, our shortage is even higher, and they're anticipating that the underlying demand based on natural birth rate and also immigration will lead to higher and higher demand all the way to the end of this decade. The number of dwellings built versus the demand is only going to catch up around 2027, but even then, that excess build rate versus demand needs to continue for a number of years to eat away or chip away at this chronic shortage. If that continues to happen, it's probably in the mid 30s, which is when our chronic housing shortage will finally be eaten away at. But as I've illustrated in different episodes, that's a really hard outcome to achieve because right now we have almost 100,000 deficiency or shortage in tradespeople according to Housing Industry Australia. And also, we have all three levels of government not working with each other, and NIMBYism as popular as ever, which is to say, we're not going to build in my backyard. Let's let another neighborhood or another suburb or another city solve this housing crisis problem. So these are very optimistic numbers from a build rate perspective, and even still, the housing shortage is only going to come down to zero at this rate in the mid 30s. That's 10 years away. Australia has one of the highest population growth rates, as driven by, of course, predominantly migration. It's actually only second to Israel, and we all know Israel has very unique immigration policies and settlement policies, to say the least. So Australia's population over time really started to tick up. That gradient or rate of rise really started to tick up post 2007, 2008. And it's economic realities like this that this 18.6 year cycle fails to consider, because when you have a shortage of houses, when you have massive immigration, when you don't have enough tradespeople to build, it's a perfect storm of continued house price growth. And of course, I'd be doing you a disservice if I didn't try to explain that there is not just one housing market in Australia. There are 15,000 suburbs, and they all have their unique cycles. For example, if you look at Sydney's growth over the last 50 or 55 years since 1970, it follows a unique trajectory to other places. Let's say, like in the last 10 years, 2010 to 2020, Sydney had a huge run up. It grew by more than double, whereas Adelaide during that period of time, and Brisbane for that matter, were pretty flat. So, how do you overlay this 18.6 year cycle at a national level? You can't, because each locality, suburb, council, city has its own supply demand dynamic. You can't say Australia's in for a big crash in real estate prices if there's an area that hasn't grown much at all in the last 15 years. And I know it's easy to think that everywhere has doubled, everywhere has gone up 100%, if not more, since COVID. But that's simply not the case, especially if you're living in Melbourne. You just have to look around and realize that Melbourne house prices have only risen 9%, 9.8% actually, according to CoreLogic, since the start of COVID. And there's other places like that as well. So, in conclusion, does the 18.6-year cycle exist? Well, the theory is solid. The underlying intent of the theory, which suggests that stock markets, housing markets, economic cycles are fluid, they're not stable or linear, that is 100% true. But can it be used to time entry and exit points in the housing market? You have to ask yourself which housing market, and you have to ask yourself, does this theory still exist given current supply demand dynamics? And you have to ask yourself, did the symptoms of this 18.6-year cycle manifest in Australian house prices? And if you go back, like I started this episode with post GFC, we had a huge explosion, which was not meant to happen. It was meant to be a recovery. So it seems to be all upside down. If you take my advice, which you don't have to, you should follow the data and never me or never anyone else on a whim. Analyze the property, the street, the suburb that you want to buy in and analyze its cycle. And I've done other episodes on how to do that. Right now, across Australia, there are 43 suburbs where you can buy a house or unit, not that I recommend units, for under 400K. If you only have a tight budget, maybe you're only starting off with $50,000, $60,000 of capital, your deposit and stamp duty, try to consider one of these areas. Try to understand which is on its upward cycle, which hasn't had huge growth in the past, and try to time the market because you can. We're not living in the 70s, we're not living in the 80s. With data, we can time the market, and it's timing the market plus time in the market that will get you out of the labor market, out of your job, so you can be financially independent. Hit the subscribe button, give it a thumbs up. My name is PK. I'll link links below to my Facebook group with more than 60,000 people who are doing exactly this. Thank you for being with me, and share this for someone who needs to hear it.